and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host here for about the next, let's say, 25 minutes here on Options Guide TV. We only have two things that we really have to cover today. Today's date is Friday, May 31st, 2024. The markets are open, they're rocking and rolling. This week we focused on the NDX. And our trade was kind of all over the place whenever we're looking at a skip strike butterfly. And we kind of approached it as an alternative to selling a short spread. We did a skip strike butterfly. That's the way that I would phrase it. We brought in a decent credit to the account, and we did this trade in the NDX. Looking for a little bit of weakness in the NDX, in that we've had such a big run up in NVIDIA, maybe a little bit of sell-off there. Also, some of the other stocks have all had real strong runs in the month of May. And I'm just looking for a little bit of settling down in volatility overall. So the trade that we did on Wednesday, because we only had 2 days. On Monday's show, we actually had the market holiday, so we came in on Wednesday, did a very short-term trade in the NDX. And I think we're going to do a rinse and repeat in that, because I feel like my opinion on what's going on in the NASDAQ really hasn't changed much. Neutral to bearish. And if the market goes up, we are also okay. We just don't need the slamming move to the upside in the NDX. So we're going to look at another fairly cash intensive, in that if we're looking in the NDX and we're talking about an $18,305 index, that's where the index is trading at right now. It's actually down 1%, which is, well, actually 1.25 now. Now that I look at my screen, we're actually just took another leg lower. So we're down $233 on the NDX right now, which is 1.28%. So I think we'll take some of that volatility, the fact that we've had a jump up in implied volatility, and that has happened recently. If we look at the markets in general, I'll just quote a couple of numbers here. We got the VIX index currently trading at 1440, and it's flat on the day on a fairly big down day. Actually, if you look at the Meg 7 stocks, which there's a lot of red. Apple, Amazon, Google, Meta, Microsoft, NVIDIA, all down between 1% and 2% on the day. Even Tesla is down 2% right now. So the leaders of the marketplace are struggling. The NASDAQ is struggling a little bit. And I think that has a lot to just do with that markets need a little bit of a pullback going in. Well, just the fact that we had such a strong month in May, and that was led by NVIDIA and their announcement of a 10-for-1 stock split that they have the date now. It is going to be June 7th when they do the 10-for-1 stock split. I'm actually going to put together a little article that's going to explain what's going to happen in NVIDIA options, and I will have that posted on optionsplaybook.com. So that's the plan. All right, so let's just look at the trade that we set up on May 31st expiration. Trade worked out just fine. And I'm going to pull up my screenshot. We did the trade for $1.10 net credit to the account. Our first leg of our NDX trade, and let's run to the TradeHawk software right now. I guess I'll show you this. So now that we're in the software, let's look at the first leg of the trade. It's at 19,050. This was the first leg of the trade. This is the one that we bought. It's now 0 cents by 35 cents. So fairly wide bid-ask spread. But if you see that, that's the case on all these option contracts. We're basically going out of the money, worthless, very low probability of the NASDAQ reaching this price. And I mentioned this on Wednesday's show. I wouldn't try to close it out. Everything's just going to expire worthless. We have in our trade, we have a hedge. Our hedge is our butterfly. it would be wonderful if the marketplace actually started coming back towards our strike at this point in time with 1 day remaining in these option contracts. That would be a real wonderful thing that could happen in the NDX. So these are all the option contracts going all the way back. Here's where the current market is at, 18,300, almost, I guess we're a little bit off on that. And we have a half a day for these option contracts to trade. So if we go all the way out, this is how far out of the money we are. And I guess I can even put the trade in. We went 30 points wide. Now, the only downside of going 30 points wide is that you're going to have a $3,000 requirement. So in theory, this butterfly could trade for $30. That would be the maximum that I could trade for. It would have to stop right at 19,080, 19080. That's where it would have to stop. But that's the maximum that I could trade for. That's also the maximum that you could lose. Now, if you lost that, you would have to go all the way up to the 19,140. That was the strike that we bought here. And you see right now it's actually showing the midpoint of the trade at 5 cents. I would obviously just let it roll. But if the market went beyond this strike right here, we would be at our max risk. So I like the trade. I like that we did it on a 2-day basis. Let's go a little bit further out. And we're going to do the weekend. I little nervous to do a butterfly that has this much risk in it over the weekend. Maybe we cut it back to a 25-point butterfly in the NASDAQ, mainly for the show. It's just a $3,000 requirement on a 1x2x1 skip strike butterfly is fairly high for what I perceive a beginning option trader to do. This is the trade that I would do in my account. I like the 30-point wide NDX trade. And here's the reason why. Here's the main reason why. I say things like that, but I feel like I need to explain it more in that. If you have a 30-point wide butterfly and you're looking at the 1950 strike here, the leg that you're buying, what you want, if the market comes up this way, you want this to retain its value. And you want these option contracts to start withering away. So ideally, let's say we had 1 day remaining expiration and you got to 19050. The index got to 19050, right to the strike price. If that happens, I would love to have the 19120 as my other strike that I've sold, because even though it got to here and this is going to retain all that at the money premium, these things are still going to wither away with only 1 day remaining because they're still too far out of the money. So the further you get out of the money, the dynamic in the pricing between the option contract that you own and the option contracts that you sold, the wider you go, the better off that you can be on that position. So if the market goes against you hard, you need some help on that trade. I would love to go as wide as possible and still get it done for a net credit, but then you also bring in an element of risk. The wider you go, the wider you got to go out on the strike that you're skipping over, and the more requirement you have, which means the more risk you have on the trade. So I prefer to go 30 points wide is where we look at in the NDX. In the SPX, 20 points wide is about as wide as we can get in the SPX and get it done for a fairly decent net credit. Let's change things up because we're not talking about a 2-day trade here, right? We put this on Wednesday, and the trade lived all day Wednesday, all day, or half a day Wednesday, all day Thursday, all day Friday. Let's go. We're going to set up a 1-week trade. So we're going to be looking at next Friday's expiration. And we're also going to go 25 points wide. We'll go a 1 standard deviation move out of the money and see where that net credit is at. And that's all just the fact that we're going to manage risk. We're going to take $500 of risk off the table on that trade. This trade I'm not going to worry about. I could go out and play some golf today, right? Because I'm really not worried about this at all. If the market does come to this level, I guess I would set an alert on my phone because there might be a cha-ching, right? If we could get the market to come all the way back, way beyond a one standard deviation move. Where's the one standard deviation move? Oh my gosh. All the way down at 18,420. All right. So it's just astronomical. It's really just not going to happen today. But if we did ever get to that level, well, then I just want to know when I'd want to get out. So I would just have an alert on my phone to tell me that the NDX actually hit 19,000. That would be it. Okay. All right. So if you have any questions on that trade and you are in the Tradier YouTube platform, I will be happy to address that trade. But with that said, let's zoom back out a little bit, and I'm going to run over to the options playbook, and I'll bring up the skip strike butterfly. So let's do that, and allow me. And if you have any questions or comments, please put them in the chat box. I'll be happy to answer them. And boom, we're going to pull back the options playbook. And we've recently made some adjustments to the options playbook. So let's show it. And we have a search bar. So you can actually just put in the strategy. If you know the name of the strategy, it only searches on the website. It's not going to give you, what's the definition of a margin call. You can only search for strategies. And then also we have them all labeled in this little drop down here about option strategies. So that's something that we just recently did this week. And skip strike, we're going to do skip strike butterfly with calls. And we're going to do the rinse and repeat. We also kind of drew a little graphic. I've got to adjust the one for the skip strike butterfly. I like the one for the regular butterfly very well, but this needs to change a little bit. But we're actually just show you from 24 days, the graph details. It automatically draws it over time, kind of how I show you inside the TradeHawk software, how the profit and loss graph works. This does it on a generic basis. But this is what we're looking to do. We're going to buy a call, strike A, sell 2 calls, strike B, skip over strike C, and buy a call at strike D. Generally, the stock will be at or below strike A. So it's going to be all the way down on this end of the trade, all the way down this way. And as the expiration approaches, you want this line eventually starts morphing into the profit and loss graph. But at the very beginning of the trade, if I pause it right there, as we go into the middle of our strike to start with, we are bearish on the trade. We are not bullish at all. We're not bullish on the trade until we get to about right there, which is basically this would be the Friday of our expiration that we are going to do to see a graph that would look similar to the way the profit and loss graph looks right now here on the skip strike butterfly. So let's zoom back out, pull it back out. Let's go on into the TradeHawk software, and let's look at setting up our trade. June 7th would be the Friday expiration. You click on June 7th up here inside the options grid. You got the calls on this side, you got the puts on this side, and I always want to make sure you're in the right expiration by looking right here. So right now the market's at 18,300. One standard deviation move is going to be highlighted by the gray on the chart. I always like to double check and look at where the delta is at. So it's somewhere between 18,710 and 18,720. That's fairly close. 16 delta is usually about where a one standard deviation move is at. So let's try using this option contract. We're going to go see how much of a credit we can bring in if we go 25 points wide. So 18,710. Let's start with this one. I want to give myself a little bit more leeway. Let's go here. And this is right on the 15 delta. And we're going to do the 20 and then 25. See, we got to go 30. It's not giving me the 5-point wide possibility this far out. So we will we'll do 30. I don't have a choice. I don't have the 25 strike. So that's what we're going to have to do. And then we're going to sell 2 of these. We're going to skip the 80 and we're going to go to the 810. That would be 60 points higher than this. We're going to buy that one. Okay, so we're getting a real big credit here. I would like to do it 25 points wide. Credit would be somewhere close to 190, probably 180. But right now, if you look down here, we're seeing the midpoint credit at 225. So we're going to have a $3,000 requirement. We're going to bring in a credit. We'll call it 240. I see 240 right there. That's going to be our paper trade, $2.40. So if you take the 30 points that you have to do this, so 30 minus the 240 gives you a price of 27.60. So your maximum risk on this trade is $27.60 or $2,760. You have to have that in your account. Low probability of that happening, but there is a probability. You know, I always try to say it this way. It says that there's a 10% chance that this can finish 1 cent in the money, just looking at delta, which isn't an exact science by any means. And if you look at that trade and you're saying that's the probability, just think about how many times a weather forecaster says there's a 10% chance of it raining today, and it ends up raining. So there, you have a chance that it will happen, and that would be where your max risk is at. If I'm putting this trade on, though, I'm not going to let the stock get to that range. If I hit this strike, I'm going to get out, and that's always my rule, no matter what. We looked at a skip strike butterfly the other day, and somebody mentioned that we had 1 day left, and it had gone through our strike because we don't tape Options Guide TV every single day. And looked at the trade and said, well, it might come back. And I kind of felt like it would come back too. Like the market, I felt more that the market would come back to our short strike than continue on to the higher strike. And when you get to the last day, the gamma is just too strong. If we get this far in the money on these 2 option contracts, you just don't want to be in that trade. You don't want to play with this maximum risk. So my rule to the story is that we ever get to 18,750, no matter if you're up or down, because you could be up on the trade when it gets there. No matter where you're at, you're going to get out of the trade. And that's just the rule of thumb on the way that I would approach my skip strike butterflies on any trade that I do. That's my maximum risk on the trade. I don't care if the Bollinger Band just ran into the moving average and, you know, ran over a reindeer. It doesn't matter to me. This is where I want to get out of the trade, and it's all about managing the risk. All right, so let's send this to the what if calculator. And now remember that this is all in theory when we talk about the what if calculator. And it assumes that implied volatility stays the same. Everything stays the same if we do this trade. And to start with, the market is right here. This is our green line. This is our risk. So a lot of risk. If we put it on right now and it ran to 1,058, to our short strike, which is 18,750. 18750. That's our short strike. If it did that, we would be down, and you have to look all the way over here in the corner. We would instantly be down around $1,050, $1,060, somewhere in that range. Okay. If we got directly to that strike. Now, everything changes dramatically. Even if we can make it through the weekend, this green line that's highlighting our profit and loss graph as of today, in theory, right, at 11:19, so it's even showing you the time on this. If we go another day and we make it till the 4th, to the 3rd, which is Monday, watch how much this line changes. It's not going to move a ton, but it's going to jump a little bit. So let's go and look at it. Now all of a sudden we see right about in this range, the curve is definitely steeper. And then we go one more day. Let's go to let's go to Wednesday. Let's bypass Tuesday. Not July, June 2nd. Okay. And let's go to Wednesday. Why does that keep doing that? All right. And there we go. That's why I need to do it. I see what was happening. It wasn't the profit and loss graph. It was the user. Okay, so here, and then we go to Thursday. Now it's getting interesting. So anywhere in this range, we're profitable. We still haven't made this turn up. So we got one more day remaining to expiration. I was kind of showing that in the graphic that we had on the options playbook. But now we have one more day remaining. And so let's go to Friday. Here we go. Now we're looking really good in anywhere within this range. And that is at 11 o'clock Eastern time on Friday. Let's go to 419 and a lot more. And then we got a couple more hours. And we are going to be reaching that middle area on our price. This just isn't working. I'm not liking what we're got going on here. All right. And so if we run back to the trading screen, we'll set this up one last time. We're now around 220. We're going to keep it at a 255. Okay, 240 is going to be our net credit. That's where I want to do it. So we're looking to buy the NDX 18,720 strike call with the June 7th expiration. We are then also going to sell 2 of the 18,750 calls and then skip over the 80, the 18,780 and buy the 18,810 call. We're going to do this for a net credit of $2.40 to the account. And that's going to be it for this edition of Options Guide TV. Check in to see if you have any comments or questions about the show. If you do, put them in right now. Give you a few more seconds. And if not, that's going to be it for this edition of Options Guide TV. We'll be back on Monday at 11 a.m. Eastern time for the next edition. We'll see how much time decay in real life we can get in the NDX. At this point in time, it would be better if the market continued on down, which it has actually. Right now, I'm already seeing the NDX down 1.4%. When we started, it was 1.28%. So the market has gone down. It's now down 257.92. So the markets are having a rough day. Thanks for coming, and we'll see you on Monday.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.